This is the one I was referring to, the one with the animation.
Okay, this one?
Yeah.
Like the
Slide 27 in chapter 7 in
okay.
your notes.
Okay, yeah, right. You don't like my lines that went like this? That was
That's
hard. That was hard to do.
that's the one.
Okay. Um, yeah, all right. This is a good example of that. So antiques, right? They sold for a gain of 3,000. That would be an example of something that we call collectibles, right? Antiques, artwork, jewels, precious metals. So that's going to be a $3,000 gain in this category. The rental home, right? So now we've got real estate used, right? In a business, right? They're just going to tell, right? So they sold it for, their total gain was 210,000, right? You can see that. And so they just tell us that 30,000 of that is 25% gain, right? Unrecaptured 1250 gain. So, right. So we can tell from that they've claimed $30,000 of depreciation on this real estate property, right? If we weren't already told what, right? So 30,000 of that is going to be here. And the other, right, that was 210. So the other 180 is going to be, right, right, once it's, right, bigger than the depreciation, the other, right, this is, right, this is actually, right, unrecaptured. Or no, sorry, that's just a 1231 gain, right? It's, right. And so, right, if that's all of their assets, right, if they had more 1231 transactions, we would want to net this with any losses. And we would want to do look back, right? This problem doesn't give us any of that information, so we're assuming this is all that's happening. So once I have, so now this becomes a net 1231 gain, right? Because there's nothing else to net it against. So now it gets treated as a long-term capital gain. All right. Jump in if you've done this problem and I made a mistake. But right, I think that's all of our transactions. Right, so we want to net them together now. In part A, it's going to say they have $20,000, right? And they give it as taxable income. So we know all the deductions have been taken already. So they have $20,000 of ordinary income, taxable income. So I can net each, I just want to net each column together first. 178. This is going to be, right. This is right. I'm done with this, right? Because I already put that over here. And so in this one, they didn't have any, right? They didn't have any losses, right, to net. So we don't have to do any of the moving back and forth. We could do a couple examples like that after this one. What's hard about this problem is knowing what tax rate to apply to each category. All right, so this is a married couple, we're assuming. So we're going to use the married rates. So I always start with the ordinary income. And on this one, right, so a short-term capital gain is going to be taxed at ordinary rates, always, right? So I've got 21,000 here, right? These, right, at ordinary rates. So that would be, for them, right, it's going to be right here. It's going to be 1,940 plus 12% of the amount over 19,400. All right, so I'm just going to use Excel here. It's going to be my income, right, my taxable income minus the bottom of the threshold times the 12%. I'm always paranoid. I probably put too many parentheses. All right, plus the amount that they give us, right? So their liability on that ordinary should be that. Next, I want to go over here. I'm going to start in this category, the 28%, and I'm going to look. Okay, so they're at 21,000 right now that I've taxed already. 21,000 of this, right? Ordinary income plus the short-term gain. So that puts them here in the 12% bracket. So these are always going to get taxed at whatever's smaller. Is it at the ordinary rate or 28%? Since they fit right here, I'm just going to tax them at 12%. Right, which is the ordinary rate, right? So this $3,000 from antiques, right? Because these antiques, right, they're technically, it's a capital asset, so they have a capital gain. I think somebody at some point just said, we don't want to, right? Supposedly capital gains rates are to encourage investment and stuff like that. And so we don't really want to give somebody the full capital gains rate for investing in antiques. So we're gonna tax them at more than the preferential rate of like 15%, but we don't want to punish them either. We're not going to make them pay more than what the ordinary rate would be. So if their ordinary rate is less than 28%, they get that. It's going to be the exact same on these unrecaptured real estate gains. It's going to be the lesser of 25%, or right here, right, even with the 21,000 plus the 3,000 that we've taxed, now we're at 24,000, and we still fit in this range for sure. So these are also going to be 12%. Those got taxed at, hold on. I'm actually going to want to take this. It's going to put this over here in my tax liability column to keep them together, right? So that's going to be 360, 3,600 for this one, right? So far. So now I've taxed all of this, and now I have my long-term capital gains. So I want to go to this table, and what I had to figure out where to start. This is a little tricky. Where I start is I want to take all the income that's been taxed at ordinary rates already. So for this problem, all of my income so far has got, right, even these gains got taxed at ordinary rates. So I'm going to count all of these, right? So this is 21 plus 3 is 24 plus 30 is 54,000. Right, does everybody see that? All right, I have 50, right, that's taxed at ordinary rates so far. So start here in the long-term capital gains table. So this is what already got taxed at ordinary rates. That's where I'll start here. So they're going to start in the 0% bracket. But they have a huge capital gain, so it's not going to all fit, right? Because it only goes up to 78,750. So I'm going to take 78,750, right? I'm going to put this here. Maybe it'll make more sense, right? This is the top of the 0% bracket. So if I start at 54,000, that means take the top of the bracket minus my starting point. This is how much fits in the 0% bracket. All right. Once I start at 54 and I put in 24,750, that gets me up to the top of here. So that much is taxed at 0, right? Because of their low ordinary income. No tax on that, right? But I still have more gain that hasn't been taxed yet, right? I have this is my full long-term capital gain, 24,750, right? It's taxed already. So I've got this minus this. There's this much long-term capital gain left, right? About 153,000. So if I look here, right, I got up this 153. Now that's all going to fit, right? Right, because this bracket is huge. That's all going to fit in the 15% bracket. All right, that's going to get taxed at 15%. So they're going to pay that times 15%, right? And so then their total tax liability is going to be, right, read that. Could be embarrassing, but I'm going to check if that's what the answer is. Yep. If 29,080 if we round it up. All right. Any questions about that? It's a good one to remember, right? If we're going between the brackets on capital gains or dividends, it's kind of tricky. So we can look at part B just to reinforce that. This is saying, what about the same facts as this, except instead of 20,000, they had 400,000 of ordinary taxable income on top of these other transactions. All right, so it's going to be similar, right? If we had, now we have 400 plus the short-term capital gain, 401,000. That's going to get taxed at the ordinary rates. So now they're up to the 32% bracket, right? Married, yeah, right. They fit in this range, so they're going to be 65,497. And now, right, it's 32. And oh, I didn't. What was that? I missed 65,497 minus 321,450. Right. So just using my formula, this should be their tax on the ordinary income and the short-term capital gain. Now, if I go, right, I'm going to start at the highest here, 28%, right? I had this gain from the antiques. Now, right, if I look where they're at, their ordinary rate's now up to 32%, so 28% is lower. So I'll use that, right? The lower of 28% or their ordinary rate. It's going to be the same for this real estate unrecaptured 1250. It's going to be 25%. Because 25% is lower than the 32% where they're at. All right, so I have my liability for those so far. Now I've still got this long-term capital gain. So what's different here is where I start, right? My starting place is all the income that's already been taxed at ordinary rates. Well, now this gain and this gain, right? They didn't get taxed at the ordinary rates. They got taxed at their max special capital gains rate. So I don't have to count them. I'm only going to count this income that got taxed at ordinary rates, 401,000. So for a married couple, I'm going to start here at 401,000. All right, so they're going to start in the 15% bracket. All right, the top of that bracket is 488,850. That's the top of the 15% bracket, minus the 401,000 taxed at ordinary rates so far. Gives me 87,850. Let's see if I can. Right, this is the amount that's going to be taxed at 15%. Right, but once again, because they have this big capital gain, it's going across, right? It gets this 87,000 gets them up to the top, and the rest is going to spill over into 20%.
Sí, 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 aquí, bien con la familia, ya sabes, siempre pasándola bien. ¿Y usted ya cómo la pasó?
So, right, minus.
Sí, ¿cómo te fue bien?
All right, now we have another 90,150 that gets taxed at the top 20% rate. Right, and so this would be their tax liability in Part B. All right, let me see. Okay. So that, right, so that one's mostly good, right? We did a little bit of, right, putting things in the right category and doing the capital gains when it's across different brackets. Any questions there? All right, so I'm gonna, let me take my, all right, what if I mean, this is a little tricky. We could make up some different numbers. All right, so what if somebody started, what if we're told somebody has a $4,000 long-term capital loss carry forward, right, from a prior year, right? It didn't matter where that came from last year. I'm always going to start it. I'm always going to start it right here. It gets to start in the highest category. And what if we're told, right, somebody, right, you get these carry forwards because you can only deduct up to $3,000 in 1 year. What if we're told somebody has a $5,000 short-term capital loss carry forward? That's always going to start here in the short-term column. So we could throw some other things in here. Maybe they had an unrecaptured gain, and maybe they had a long-term capital gain, and maybe they had a short-term capital gain, and they had some ordinary income. Or let's say we could pack some even more review in here. So our 1231 gains and losses. All right, they had a $2,000 loss and a $3,000 gain. Well, let's make this even bigger. Let's say 5,000. So first, all right, they've already done their depreciation recapture. So they have a $3,000 net gain here. But what if we're told they have $2,000 of unrecaptured net 1231 losses from the prior 5 years. All right, if I know that, all right, this problem I don't have to go year by year. They just tell me what the number is. So I'm going to take 2,000. All right, this is going to be my look back recapture. That 2,000 is now going to become ordinary income. Put a shape in there for you. Okay. And now I'm down to a $1,000 net 1231 gain. So I can count this as, now that I've done all my steps, now this can be treated as a long-term capital gain. All right. All right, so if I have these, right, I don't have a lot of netting to do in each column. I'm gonna get here. So now I want to allocate, I want to go through and, right, I'll always start here. All right, so this is gonna, right, this is a loss, so it can offset gains. And first it's gonna go to the very next category. So I can take 2,000 of it here, bring me down to 0. Right, there's still 2,000 left. So another, right, I have another 1,000 that can come here. Right, so 4,000 minus, right, the 2,000 went here, 1,000 went here, there's still 1,000 left. And so at that point, I can actually take that 1,000 and I could put it here, except I don't have a gain here. So I'm just gonna finish with 1,000 here, and this is gonna become a carry forward for now, I think, right? I may have gone in too deep here. All right, but if I go to the now my short term, right, I've ended with a $3,000 net loss. Let me put it right here. I want to check the rules, which one I'm supposed to use first. Do I have chapter 7? Where do I do my netting? All right. All right, so if multiple categories have net losses, the $3,000 that I can use against ordinary income comes from short term first, okay? So I would use this one first, then this one, then this one, right? So this 3,000, I'm gonna do it, that I have here, I can offset, right, up to 3,000 against ordinary income, bringing me down to 119. And right, this one is a carry forward. All right, so, in this case, I would just tax everything at ordinary rates. And next year, this carry forward is going to start right here in the same column. Any questions about that? Let me try a slight variation on it. We can just see one more thing. What if that was a gain and this was a loss, right, from selling stocks or something? All right. What if I had all this and all I had was a $2,000 1231 or a loss, right? So I'm gonna, if I don't have any other gains here, I'm just gonna have a net 1231 loss, right? So if I have a net loss, I get to put it here. It gets to reduce my ordinary income. All right, so that'll bring me down to, we'll net that later. All right, so what's different here is, right, I'm always starting here at the highest on the long-term side, but it's a gain, so I'll leave it and move on. This is a gain, I'll go here, right? So this is my first loss. I've kind of been moving this way, so I kind of want to go here, but a long-term loss has to go against long-term gains first. So it's going to go back over here. And all right, so that's going to reduce that gain. Now that loss is gone. And I still have this short-term loss. And ordinary income. All right, so now that I don't have any long-term losses, I just have this short-term loss. Let me make it a little bit bigger just to make it more interesting. Okay, what if it was 10,000? All right, so now I have this short-term loss, and it can go over here. I can take 3,000 of it to eliminate that gain. I still have 7,000 left, so I can take 2,000 here. All right, so that's going to, all right, so now all my long-term gains are eliminated. I used up 3 plus 2, 5,000, so I still have $5,000 of loss left. Well, 3,000 of that, right, I could take here. All right, again, right, because the most I can take against ordinary income with these capital gains is 3,000. So that's going to reduce my ordinary income, and I have $2,000 that I couldn't use, right? This is going to be a carry forward. Because it came from the short-term side, it's going to start next year as a short-term capital loss right here, 2,000. All right, so I think that's some pretty good variations on things that can happen when we're doing the netting. Any questions? Maybe I lost my connection like 20 minutes ago. Nobody hears me. Okay.
Can you repeat that? Which one have a limit?
You're still on.
Okay. Sorry. Yeah, go ahead, Long.
Yeah. Can you repeat that? Which one have a limit of 3,000 again? I'm sorry. I kind of forgot.
Where did this 3,000 come from?
No, like which one has the limit of 3,000? I know short-term gain have that limit.
Yeah. A long-term would too. That's a good question. Let me do. All right. What if we were a little bit different? Right, what if I didn't have any short-term? Or I can make it. It was small. And these were bigger. All right, what are we gonna? Okay, I think this will work. All right, so right, this I would start over here. The 7,000 would come here. All right, I mean, I would just do 2,000. Would bring me down to 0. Right, and so now, right now I have 5,000 left, and I have 1,000 here. All right, so now first, all right, I can use this rest of this 5,000 over here. So now my short-term gains are gone. What am I left with? 4,000 left of this one and 1,000 long-term capital loss, right? So that when I don't have any short-term gains, then it's the same thing with these net losses on the long-term side. I can still only use 3,000, right? So that limit applies to short-term and long-term. I'll use, if I have them, I have to use the short-term first over here. Then now this one is going to be coming out of here, right? So this is now going to be 1,000. I'm going to use this higher rate one first before I get to use this one. So I'm going to end the year with that's kind of confusing, right? Yeah. All right. My ordinary income came down to 117, and right, I have these 2 long-term carry forwards. They're both going to start next year. I'll start with 2,000 in this category, negative 2,000. Does that make sense? Any questions?
Yeah, so basically every single loss is only limited to 3,000. Like, doesn't matter which, right?
Right, exactly. Except if I had a net 1231 loss, there's no limit on those.
Okay.
All right, so this could have been 12,000, and I still would have subtracted it here.
Okay. Thank you.
I have a question for like the long-term capital gain.
Yeah.
The preferential rate.
Mm-hmm.
There's like times where you only use like part of 15% and part of 20%.
Uh-huh.
And I was just wondering, like, I don't understand, like, why? Like, cause like there's certain problems. It's like, I think it was like in chapter 7, like when the homework problem.
Yeah. So we just went through that problem.
Okay.
Yeah, we spent like 40 minutes on it. So I don't want to make everybody go through it again.
Okay.
But if you look at the solution should be on Blackboard now to that problem.
Right.
And you record this video anyway, so you can post it and he can rewatch it.
Okay. Was I recording on that part?
Yeah, I think you
That
did.
after you. Okay. So I will post it. So you might be able to see me go through that on the video right after we finish here. I'll post it. Yeah.
Okay.
But yeah, basically our rule is we're going to take all of our income that got taxed at ordinary rates. That's where I start on the long-term capital gains brackets. And that's going to tell me how much I can fit in each, right? 15 or 20 or 0.
Okay.
But yeah, I'll put that video up so that should make sense after that.
Ready.
Let me say something on chapter 10. All right, so if you you probably see in a lot of the homework problems, right? We had something called qualified improvement property, right? And the reason that showed up a lot in the homework problems because it was something that was not, you couldn't do bonus depreciation on it, so you would do 179 expense. All right, so which was the law until like December 31st or something like that, or maybe even later. No, just during this crisis, one of the stimulus acts that they passed is that qualified improvement property. So this is not, you didn't build an actual building. I mean, right, you don't need to know this for the test. This would be something like I own a building and I put in a new HVAC system, right? Or I put in a new hardwood floor throughout the building or something like that. All right, so now, right, the CARES Act is what Congress calls this, right? They really love the acronyms. Right, CARES Act, this is now eligible for bonus depreciation. All right, because that's confusing, and right, the law was one way while we learned it, now it just changed. Right, I'm not going to put qualified improvement property on the exam, okay?
Yay.
Yeah, you're welcome.
So I have a question for,
Yeah.
it's about like the Section 179 and the bonus depreciation.
Yeah.
So like, when do we, if we have like multiple assets,
Mm-hmm.
or, like multiple equipments and stuff,
Mm-hmm.
which one do I put the 179 max, like the maximum deduction for 179, and then the rest on depreciate, and then rest on bonus depreciation?
Good question.
What do I put first?
Good question. That's gonna be so. Let me say something first to preface that. Don't make that right. So for the exam purposes, right? All right. So basically, it used to make sense, right? There were some things that I couldn't do bonus depreciation on, so I would do 179 on those. All right. But now, right, there's not much difference. So basically, all right, if you see anything other than, right, real estate, right, buildings, you can just do 100. You can just do 100% bonus depreciation. All right. So if you're trying to get the max deduction, the simplest way would be to just take bonus depreciation. All right. But I mean, you could also do 179, right? If you want, and that would be fine.
So if there's like a problem with the 179 and the bonus depreciation,
Yeah.
what would I do? Just put all bonus depreciation and don't even worry about the 179?
I would do that just because it's simpler.
Okay.
But if it's eligible for 179, you could get the same amount that way. That's fine too. But
Okay.
right, if it's a building, right, like a building used in a business or a rental property, right? The building itself is not eligible for 179 or bonus, right? So you have to use the regular maker's depreciation, right? Which is gonna, right? So I'm just gonna look at the table for, right, either residential or non-residential real property and do that.
Okay.
So it's pretty simple, right? But I can't remember, right? So you might have a question where, right, if it says for some reason, don't use bonus,
Right.
you should still understand the basic rules for 179 as far as the phase out and the taxable income limitation, right? And a fairly straightforward example of that. And yeah, if you're trying to decide which asset I use 179 on, you always want to, if you're trying to maximize this year's deduction, you want to use it on the asset with the longest life.
Longest life.
Yeah. So if I had a 5-year property and a 7-year property, I would use it on the 7-year property first.
Hello, Professor Cutler.
Yeah.
On that note, regarding using it on the longest life.
Yeah.
Does let's say there's an asset, right, and it's in the fourth quarter.
Yeah.
Would you rather use it in that, like, let's say that asset causes it to use the what is it, the mid-quarter convention?
Yeah.
Would it be more convenient to use it like in that situation? So
Yeah,
like,
right.
so it won't be mid-quarter? Because I think I think I got that from the homeworks, but I'm not too sure.
Yeah,
But
there was.
I remember that came out, I think.
Yeah, I think there's a problem. That's a good thing. Thank you. I forgot about that. So depending on the numbers, right, it could change. But yeah, that'd be another reason. All right, if you had fourth quarter property and maybe it's even 5-year property, but once you do 179 or bonus on something, then it comes out of whatever you deducted there comes out of the calculation as far as that 40% in the fourth quarter, right? As you know, deciding if you have to use the mid-quarter convention. So sometimes you might want to put your expense on the fourth quarter property first, because that could get you back to half-year convention for depreciation.
Okay, so for like fourth year quarter, just use the 179 expense, and then if it's lower than 40%, I can use the half year convention on that.
Yeah.
Okay. And then I also have that question about that mid quarter convention.
Yeah.
It's like when we're selling the asset, I've seen like in the YouTube videos,
Mhm.
like it's like for sometimes it's over like I'm not sure how to say it. Like let's say there's like an asset, sell it around May,
Mhm.
all right, and then so it's like previous quarters plus half of that quarter, right?
Yeah.
And then so is it like if it's like 80,000, it's like 80,000 times 2.5 divided by 4.
Right. So it's gonna be 80,000 times what the regular rate would be for the full year, times 2.5 over 4.
But sometimes it's like it's always like I've seen like problems where it says like 7.5 over 12 for the mid-quarter convention.
That sounds like the mid-month convention for real estate.
Yeah, I mean, because like sometimes it was like I don't know why, because I saw it I believe I saw it also on the YouTube slides,
Mm-hmm.
where it was for the mid-quarter convention, it was not divided by 4, it was divided by 12 months. Which is what it kind of confused me a little. That's why.
Yeah, I wouldn't. Yeah, I would ignore that.
You ignore that? Okay.
Yeah, just use quarters.
Quarter.
But for real estate, it's going to be months.
Months. Okay.
Mm-hmm.
Alrighty.
Yeah, we could do, right, let's suppose we could do a simple example, right? Let's suppose Bob buys furniture for his business on May 3rd for $14,000. Right, so let me see if I have if I look at the depreciation tables, right? So my first step is furniture is 7-year property. All right, so I don't think you'll have any assets that won't be on, right, within this little table. Right, so it's 7-year property, right? And because this is all his property, nothing was in the fourth quarter, so I'm going to use the half-year convention. All right. 7-year, half-year. So all I have to do now is look at the half-year table under 7-year property for year 1. All right. The only hard part about this is that these are percentages. So it's going to be 14.29%. So I'll take the full initial basis times 0.1429. So then getting the right table is the key. Then, all right, let's say this is May 3rd, year 1. The hard thing one of the tricky things that can happen with the maker's depreciation is, let's say Bob sells it on June 1st of year 2. Right, so because he sold it, the table does everything for you that it can, but if you sell it early, then you have to apply the convention yourself. So the first thing I'm going to do, it's year 2. I'm always going to stay in the same column. I'm going to take the rate from year 2, I'm always using the initial basis. I already forgot it. All right. And then because I'm under the half-year convention and I'm selling it before it's fully depreciated, I'm just going to multiply this by 1/2, right? Or 0.5. Right? And that's going to be my year 2 depreciation. All right, so what if I had, all right, once again, Aaron, if you missed this earlier, I have all these depreciation tables, all the depreciation tables that we might use, I have them in one file. I'll put it on Blackboard right after this. It'd be, all right, you can easily find these on your own, but if you want to have them in one place before you start the exam. What if I said same facts except Bob bought the furniture on October 3rd. So what would be different now?
It would be just to use, it's 40 more, if assets over more than 40%.
Yeah, so,
Quarter.
exactly right. So since this is his only asset, 100% of his assets were in the fourth quarter. And so since 100 is more than 40%, now he has to use the mid-quarter convention. All right, so once I've done that, now it's just a matter of looking at the right table. All right, so he bought, if it's October 3rd, that's the fourth quarter, 7-year property, I'm going to use 3.57%. So I'll take the 14,000. Okay. Right, so that's year 1. If we do the same thing, Bob sells it on June 1st of year 2. I'm always going to use the initial basis. My temptation is because Bob sold it on June 1st, I'm going to want to look at the second quarter. But no, right? I started here. They've done the math for you based on, right, what your basis, reduced basis would be. I always stay in this quarter where I started. So first, I'm going to pull the full year rate, year 2, for my 7-year property put in service in the fourth quarter. All right, now I'll apply the convention myself. So he sold it on June 1st. That's the second quarter. So he gets the first quarter and he gets half of the second quarter. So 1.5 quarters out of 4. That's going to give me his year 2 depreciation, right, for makers. All right, so once again, that's just what I would do if the problem asked me what's ignoring 179 and bonus, what would his depreciation be? If it didn't say to ignore 179 and bonus, Bob could have just deducted 14,000 in year 1 if he wanted to, using either 179 expense or bonus depreciation.
The bonus depreciation is only for the first year, right?
Only for the first. Same with 179. It's only for the first year.
Okay.
Congress is trying, right, ostensibly they're trying to influence somebody's decision to buy something. So if they already bought it last year, then they're like, well, you already bought it anyway. We don't want to give you the incentive. I guess that's how you can remember it.
Hello, Professor Cutler. I have a quick question.
Yep.
Do you remember the Ron and Ann problem that we had like in chapter 7 homework?
Yes.
So when we're like trying to figure out like what rate goes where, in what order do we put it in? Like you know how they have like the $400,000 income?
Right. So we went through that problem.
Oh yeah, sorry about that.
And I think I got it recorded.
Oh, okay. So you're gonna upload it?
I'll upload it.
All right, gotcha.
Assuming that works. Yeah, but your general rule is whatever income has already been taxed at ordinary rates before you get to the long-term capital gain, that's your starting point.
Oh, okay.
But yeah, I'll post that. right? So let's say, what if this was the same? Wait, what if Bob bought a building for $140,000 on October 3rd, year one? All right, so so we need to know what it's for. Let's say it was an office building, or let's say it was an apartment building, right, that he rents out. So I just want to look for residential rental property, and where he bought it in October. So for year one, it's going to be 0.758%. So 0.00758 times his initial basis in the building. Right, that's going to be his year one depreciation. All right. Let's say Bob sells it on June 1st of year two. All right, so first of all, I'm always using initial basis, and I'm always going to stay in the column where I started, although you can see with real estate, it doesn't usually matter in the middle years, although on residential, they do alternate. No, they do this. See, sometimes they make it slightly different. So I always want to stay where I started, 3.636%. 6.3, or was it 6.3? 3.636. Okay. And real estate is always under the mid-month convention. So if he sold it in June, he gets January through May, he gets the first 5 months, and he gets half of June out of 12 months. And that's going to be his year two depreciation. All right, so yeah, just to cover all our bases on the makers stuff that can happen. And anybody feel free to jump in, or what else is confusing people?
I'm a little confused. I don't know about anyone else, but I'm just confused about. I think it's like the exchanges, like you can exchange the properties.
Oh yeah.
So yeah, I don't know much about that. I'm kind of just lost on that problem.
Yeah, good question. All right, we did so much other complicated stuff in chapter 11 that it's easy to forget about that exchange stuff. So, all right, so this is right. So we call this like kind exchanges. So the nice thing, this is part of this got pretty simple because a couple years ago they made most property is not eligible for a like kind exchange, right? It has to be real estate, right? And it has to be used in a business or held for investment, right? But it could be either or, right? So I could have an office building that I use in a business, and I can exchange it for land that I'm going to hold for investment, and that counts as a like kind exchange, right? So as long as it's real estate and it's held for a profit motive, it's pretty broad and it'll qualify. But right, anything other than real estate, right, I can't trade a machine, can't trade furniture or equipment or anything like that. And it can't be foreign, right? It has to be domestic real estate that I'm trading for domestic real estate. Otherwise, it's pretty easy to figure out what qualifies as a like kind exchange. And so then basically the benefit is, right, All right, so even though you realize a gain or a loss, you don't recognize it. All right, so that means, right, it's great. So real estate people, right, maybe they have a building that they've held, they're ready to get rid of it, right, but they want a different building. They can just do an exchange, right, and you can use a middleman like a dealer to facilitate the exchange, and you can trade it for another building, and then you don't have to pay the tax on your gain, right? But it is going to get built in, right? So to your basis, right? So let me just pull up the chapter 11. Pull up the slides, right? Because that's something I have ready. So technically what we're doing is, right, so I trade my old asset that's real estate for some new real estate, and I'm going to take that gain that I didn't have to recognize, right? So in this example, I got something worth 100,000 and my basis in my old property was 60,000. So I have a gain of 40,000, but I don't have to recognize it. It's not part of my gross income. But I do, so technically I'm taking that 40,000 and I'm subtracting it from the fair market value of my new property to give me my basis. So most of the time, what's going to happen is, right, so in this example, is you're just going to keep whatever basis you had in the old property is going to be your basis for the new property. So in this example, they trade one building, right, and for another. Either they both just have to be used either for business or investment. So now I'm getting something that's worth 71,000 when I'm going to trade it to this person, but they're going to keep their basis of 23,000. Right? So you can see after they swap, right, the basis stayed the same, but they got the different building with its fair market value, right? So that would be the simple example. Is that making sense so far?
Yes.
Yeah. So then it gets more complicated, right? Odds are I can't find something that's an exact match in terms of value that I want to trade for. So I'm going to have to throw in some other property such as cash to make it work. And so when we have other property, right, that other property we called boot, right? So if it's not real estate being traded for real estate, if there's something else too, we call it boot. And so I'm going to have this full gain that I realized, and up to the amount of that gain, whatever's smaller, my full gain or the amount of boot that I got, I have to recognize that much gain this year. So let's see. I had an example where its old building was worth 100,000 and it's trading it for a new building that's worth less for 75,000. So the other party also throws in 25,000 to make the value, right, to make people willing to do this transaction. So my basis in the building was still 60,000. I got something worth 75 plus 25 of cash. So my total amount realized is 100,000. I think I've got it here probably better. Right, I got, right, everything I've got is worth 100,000. My basis was 60,000, so I still have a realized gain of 40,000. Right, since it's a like-kind exchange, I get to defer some of it, but I have to recognize up to the amount of cash that I got. Right, so the lesser of my full gain or the boot, right, the non-like-kind property I got, that's my gain this year. And the rest of that 15 I didn't have to recognize this year, so that's still a good deal. That part basically gets subtracted from the value of the new property to give me my basis. You can see, right, that's the basis I had in the old property. And the other thing about like-kind exchanges is, right, even if there's cash, right, like boot involved, if you have a loss, you can't recognize the loss. You have to defer that also. So people wouldn't usually do that probably.
So if your boot is higher than the market value, or
Right.
so will the recognized gain be the realized gain?
Yeah, right. So let's think through it. Like, so what if in this one, the new building was worth 50,000, and so they also gave me cash of 50,000. So I still have 100,000 of value that I've received. So my gain would still be 40. Yeah, and I would recognize the full gain of 40. In that case, my boot is bigger than the gain, but I only have to recognize up to the gain.
Okay.
Right, yeah, so our other kind of deferred transaction was an installment sale. Right, it's sort of intuitive, right? So let's say I sell a building or a big asset. Someone's going to pay me a payment each year for 10 years, right? I just have to calculate, right, of the total payment that I'm getting, right, my total contract price. All right, I'm going to take amount realized minus basis, basically, and I'm going to have a gain. That gain divided by the full amount realized, we're calling that gross profit percentage. That's the percentage of the payment that I get each year that I recognize as income each year. So, all right, a simple example. Let's see. Installment sale. We can say Stephanie sells land. Basis is 20,000 for $80,000 to be paid in 10 annual installments of $8,000 each. Okay, so we can see, right, she is getting 80,000. Her basis was 20,000. So she's right. She has a $60,000 gross profit or amount realized, right? Gross profit, sorry, not amount realized, gross profit or gain out of the contract price of 80,000, right? Amount realized or contract price. So that's going to equal, I don't know, is that a bad decimal? Oh, that's not bad. All right, yeah, don't laugh at my,
right?
yeah, bad arithmetic on my part. Okay, so, right, 0.75, that's your gross profit, right? And I think most people, right, if they were just asked to figure this out without knowing the rules, it's kind of what you would guess. You could figure this out, right? So, year one, she receives $8,000, right? 8,000 times 0.75 equals 6,000. All right, that's the gross income for year one, right? And it's going to be the same each year. If the payment amount was different, we would still use each year, maybe it fluctuates, we'd still use the same percentage. What can get hard about an installment sale is we have the recapture rules, right? So what if Stephanie sells equipment use in her business, basis of 20,000, right? And let's say accumulated depreciation of 25,000. Yeah, I'm just going to go 30 because I wonder if it'll make it easier. Okay. She sells it for 80,000. All right, so we can tell, right, her initial basis was 50,000, right? And so she's deducted 30,000 of depreciation. Now her basis is 20. So what she has to do on this one, right? So this is a 1231 asset. Right, it was used, or is in her business for more than a year, right? So she has to recapture the lesser of the accumulated depreciation or the gain, right? Her gain is 60,000, accumulated depreciation 30. Oh, sorry. She has to recapture up to the amount of depreciation, right? Because it's less than the gain as ordinary income, right? That's what we call section 1245, right? Recapture. Because this is not real estate. Right, and so now she's got so in year one, she already has $30,000, right, of gross income. And then we still have, she's going to get the $8,000 payment. She receives $8,000 payment in year one. Right, so now her gross profit percentage is going to be different. Right, so now, right, she still has, right, she's recognized 30,000 already. Her total gain was 60. She still has another $30,000 of realized gain. All right, so we're going to take that $30,000 over the remaining 50,000, I think. Is that right? All right, so sorry, no, we want to do this over the 80,000. All right, so this is her remaining gross profit over the contract price. So we should get, is this worse? Right, that's my gross profit percentage. Right, so when she gets the first $8,000 payment, she's going to take her percentage times 8,000, and right, she's going to, right, she's going to have $3,000 of gross income. Right, so for year one, she's going to have the 30,000 plus 3,000. In year two, it's just going to be 3,000, and so on. Year 3 through 10, she'll have 3,000. Right, but it's kind of intuitive. All right, so that's our deferred income from chapter 11.
Will she have any 1231 gain?
Yes, right. So the good question, right? So because this is a 1231 asset, the 30,000 becomes ordinary, but the other 30,000 out of the 60 is a 1231 gain. So she's going to, each year, this other 3,000 is going to be treated like a 1231 gain.
Okay.
So if she has other 1231 gains and losses, she'll net them together. She'll have to do the look back. Or, I mean, don't worry about, well, she would do the look back in year one. But yeah, if she doesn't have losses that reduce these, they'll be treated like long-term capital gains, but they'll be 1231 gains.
Okay.
I have a question.
Mhm.
Why in the year one is 30,000? I thought it's 8,000.
80,000 in year one?
Oh, no, sorry. Sorry. I forgot. Sorry. Yeah.
No,
Yeah.
no, that's fine. For some reason, those confuse me always.
Hello, Professor Cutler.
Yeah,
For vehicles that are less than 6,600 pounds,
yeah.
you can't do 179 on it, correct? Or you can?
You can, but you still have those, the limits.
The limitations?
Mm-hmm.
So
So
like I think it's like 18,100, correct?
yeah, okay, so I don't have this year. Yeah, let me pull up. Yeah, so I think it's, let me just find my slides. I don't know if I have chapter 10.
And also, I think the book has different, like the different limits.
Yeah.
We only use the limits on the slides, correct?
Correct. The book,
Okay.
when they published the book, they didn't have the updated ones yet.
Okay.
Yeah. So where's my, yeah. So 10,100. Is it, that's what I put on the slides, right?
Yeah, that's what I have on mine.
Yeah, use 10,100. Right. So you can do 10,100 plus 8,000 of bonus.
Okay.
And so since even with 179, you're still capped at 10,100, oftentimes it wouldn't make sense to do 179. Although, right, if your car was cheap enough, then you might, right, you could do 179 to bring yourself up to the max.
Okay.
Mhm.
And as for like if it's above 6,600, that's
Uh-huh.
when it would be more convenient to use the section 179, correct?
Yeah, exactly. Once it's a big, right, truck, then these limits don't apply. Yep. And so then if it's that, you could just do 100% bonus.
Oh, okay.
Because you can do 179 also, but I don't know, on some vehicles it's still there's a lower cap than the normal 179 cap. So it would be simpler just to do 100% bonus if you wanted to get the most you could.
Okay.
Mhm.
I have a question.
Yeah.
Are you posting a video going over quiz 3?
If I have time to record it today, then yes.
Okay.
Yeah, I will try. Yeah, otherwise, I mean, you can see the solutions.
Right.
But yeah, I will try to do that.
Okay. Thank you.
My shower was leaking into my crawl space, and so I've got some plumbing and mold issues making things crazy, but I think I've got it under control, and I'll try to do a video.
Can you explain about the tax-based limitation and RIP limitation? I'm kind of confused with that.
Yeah. So so if I'm talking about, right, so basically I would put all of that under a category called, right, passive activity loss limitations. Congress is basically trying to prevent people from getting deductions without really having skin in the game, right? So people would try to not really invest any money. They just have debt that would eventually be forgiven anyway. And they'd just get a bunch of depreciation loss deductions or something. So a lot of it gets into kind of complicated partnership tax stuff. So for our purposes, we're just saying there's three. All right, so a passive activity is you have an interest, right, in some sort of partnership, usually like, so an LLC or a partnership, a limited partnership especially. All right, so you own an interest in this business, but you don't actively participate in it. All right, and so that would be a passive activity. And it's not a C corporation, right? So it's not like you own stock in a company. So if that activity generates a loss, I don't know who this iPhone is. If you're this iPhone, maybe mute yourself. Here, I got it. Oh, I just muted you, right? I know the power is going to my head. All right, so if I have a passive loss, I've got to overcome, oh, hold on, 3 hurdles before I can deduct a passive loss. Also, if you have any like real estate that you rent, that's considered passive activity, unless, right, you overcome some tough restrictions to be considered a real estate professional, but right. So if I have I have the tax basis limitation, the at-risk limitation, and a passive loss limitation, right? So, I mean, basically, for the exam purposes, you're going to be told what these numbers are, because, right, it depends on how much that person has invested in the business, right, like the partnership. And sometimes these will both be the same number, but certain types of debt don't count for this number, so it could be a little bit lower, right? So if you're doing a problem, it's just going to tell you what these numbers are, and you're probably more worried about this, right? Because this one means you can only deduct a passive loss against income from other passive activities. Right? So suppose, right, I own a rental property and it generates a loss of rental property generates $30,000 loss, then, right, we're just told, right, for Walter, his tax basis and at-risk amount are both 12,000. Or let's just say they're higher, right? I don't really want you to worry about those. They're 50,000, right? So he's not going to be limited by the first 2 obstacles, right? He has enough actually invested in the property, right? But, right, so if Walter is an accountant and he has $80,000 salary, he can't use this loss to reduce his salary, because this is a passive loss and his salary is ordinary, right, active income, right? So he would have to have some other passive activity in order to claim this loss, right? So if we said Walter has $12,000 of income from his share as a limited partner in another passive business, right? So if that was the case, Walter can deduct $12,000 of his loss from his rental property, and he'll have a $18,000 carry forward from, right, that if he has more passive income next year, he can use the carry forward then. Right, so, right, technically there's an exception where sometimes on rental property, if your income is low enough, you could deduct more of the loss actually, but we didn't really get into that, so don't worry about that for exam purposes.
So if we have, if the income from the other property is a loss, then do we just add that to the rental property loss?
Yep, that would just be more passive losses that you can't claim that year. Yeah, so in real life, right, people would try to do, right, if they can, you would try to make something be considered an active business so that you can get the losses. Chapter 13, I think, is pretty straightforward. The hard part about chapter 13, for me anyway, is remembering what the numbers are. Like what's the cap on contributions you can do this year. But luckily you can look that up and have that available. I don't know if anybody's confused about the difference between like traditional and Roth plans or anything like that.
I have a question for the test. I noticed like there's 9 short answer questions.
Yeah.
It's like do we have to like type it up, or just like it's just calculations?
It could be both, right? It could be like I think a lot like the last midterm, where sometimes it was like, right, purely verbal, where you had to give 1 or 2 sentences, and sometimes it could be, right, like on the last exam, like there was one like, what's the policy goal of the earned income credit, right? And it was like, you know, maybe like a 1-sentence answer that's purely words, and there was ones that were like, calculate somebody's AGI, where it's basically all numbers. So it could be either or a mix.
Okay.
Yeah. Yeah, I think you should have 3 hours, right? Open book. Right, as long as you're well prepared beforehand, that should be plenty of time. Yeah, make sure that you finish, right? Because people lose the most points, right, when they leave a written question blank. Right, don't put everything. Right, like going back to the last exam, it asked, what's the goal of the earned income credit? If people just started telling me everything they know about the earned income credit, right, right, especially on an open book test, then that's no good. But at the same time, right, if you're, right, it's good to show your work. If you're like, well, I'm not sure, this question was vague about this, but I'm assuming, right, X, and then I get this answer, right? That stuff helps me to give you as much credit as I can. Cool. If you didn't hear this, yeah, I don't think I put it on the instructions for the tax return project, but yeah, email that to me. by, all right, 11:59 p.m. tomorrow. Right, in one file, right, if you're in a group, in the email, you know, put everybody's name in the group. Yeah. Any other questions? Don't worry if you feel like it's dumb. I bet somebody else is thinking the same thing.
Yeah, I have a question, but it was for the tax project. I emailed it to you earlier.
Uh-huh.
Yeah, it had to do with because I'm almost done with the tax project. It's just that my numbers are not adding up to the total business income. So it says that the total from the checkpoint, it says that total business income is 46,048.
Yeah.
Yeah, and from what I have is I had 58,000 from line 31.
Okay. Let me see.
And it had to do with something with the depreciation of the tax form. That's why I'm kind of just confused on that.
Let me see if I have make sure that I got your email and I just didn't get to it yet. Okay, yeah, I have your email is my next email, right, that I haven't to answer. So yeah, I will write you back after this is over.
Okay.
Yeah.
Thank you.
Yeah, no problem. Anybody get stimulus check from the government?
Not yet.
Not yet.
Yeah, I definitely got mine.
Yeah.
It's gone. Tuition.
Yeah. Oh yeah, no, it
Gone.
goes fast for sure. Yeah. Yeah, I mean they might do another round. That's possible.
Tuition as well.
What's that?
Oh, that's for tuition. If I pay out of pocket, so like most of my money goes to tuition.
Yeah. You trying to make me feel guilty?
No.
Okay.
It's a good thing because like
Yeah.
when I graduate, that means I won't have a loan to pay out or whatever.
Yes. As somebody still paying off my student loans, you will be very happy. The less that you have, for sure.
Oh, I was able to figure out the QBI. Like now it matches. So,
Okay, okay, good.
Yes.
Yeah, I'll throw that out there. This was kind of my fault. I just neglected to put it in the slides. Is that because when I first made the slides, the IRS hadn't made the guidance yet. But when you're making qualified business income, you have to subtract the employer portion of self-employment taxes. Right? They count that as a deduction against your business income, which kind of makes sense.
Yeah, but okay, I'm considered self-employed, and I had that form, but it's not subtracting the self-employed part.
On your like you did it in software.
Yes, it's not subtracting it; it's just getting the numbers straight from the what's it called, the Schedule C. Yeah, so I thought that was interesting. It wasn't subtracting that.
Interesting. What software are you using?
It was it's called TurboTax. Yeah.
I'd have to. Yeah.
And it's not free. They lied. They said it was gonna be free. They charged me only because it's a 1099.
Yeah, it's free if you do the W-2. Once you throw in self-employed.
Yeah, they lure you in.
They want a piece of that.
Yeah.
They want a piece of that.
Yeah, that's the controversy in the tax world about. Not recently. There's too much else going on, but there's the IRS is supposed to provide software that everyone can use for free, a free file program. And companies like Intuit are kind of always trying to, right? They obviously don't like that. And so, all right.
I wonder why. I mean, okay, so are we supposed to be employees for the rest of our lives? Is that the benefit, like us avoiding to pay whatever amount? I just don't get it. I know there's this thing you talked about, I forgot what it was called, that you get an incentive, like the more you make, the higher the credit it was. I forgot the name of it. And then once you hit that a certain threshold, then you start phasing out of it.
Yeah, the earned income credit.
Yeah, that one.
Yeah. Yeah, I mean, it's people feel differently about it. I mean, at some point, right, they don't want to be giving, right, if somebody makes, right, a certain amount of money, most people would agree, well, we don't want to be giving them and money anymore. The hard part is, where do you draw the line as far as who gets the credit and who doesn't?
I agree with that. I just don't like that I had to pay for the form. Like,
yeah.
I think it was $200. I forgot.
Yeah. I used something called Tax Act, which is a little bit cheaper, but I also don't have self-employment income.
The first time I did self-employed was with H&R Block. I think 5 or 6 years ago. They charged me almost $500.
Wow.
Like,
Well, see,
I
now
have deductions, just the miles. That's it.
Well, now you can be the person charging $500.
That's right.
So most of the stuff we have done is on chapter 10, 11, and 7. Do we need to worry about anything on chapter 13? I'm just curious.
Yeah, I think everything that's on the slides in chapter 13, everything that I included, you should know. Yep.
So is there anything specific confusing in chapter 13 that I should be worried about?
I don't think so. I think, right, it's pretty straightforward, especially when you can, you have your notes and you can remember what the limits are. And let me see if I have chapter 13. Let me share my screen again. So we're going through, right, we had, I mean, I'll tell you, 99% sure I don't have any questions about pensions, right? So stick to the defined contribution plans. Right, so you have the annual limits on how much an employee can contribute, and then how much the employee plus the employer can contribute, right? I think that's pretty straightforward. I think that stuff's easy when you have the numbers written down. Yeah, right. If you have like a 401k plan, whatever you contribute, right, up to the limit, it doesn't count even as your income. It gets completely excluded, right? So it's a really good tax benefit. Plus that grows tax-free. The distributions, right? So, right, especially when you can look up and remember, right? Before the test, you should be in the point and remember. I know that there's a point where if I take money out of that account too early, there's a 10% penalty. And I can quickly look and say, okay, that's either 59.5 and still working, or 55 and retired. Right? No, right. This is not on the exam. Right? Maybe you saw this year you can take money out, right? Because of coronavirus, you can take out up to 100,000 and there's no penalty. It's still taxed, right? It's still part of your taxable income. But in other years, right, we have that 10% penalty. All right, the other half of that, right, is at some point you have to start taking money out, or there's penalties. I think that's pretty straightforward, right? It's just a matter of reviewing that and remembering that. I mean, right, if you can understand this example, you should be fine on that. All right, and so understanding the Roth plans, right, is the difference there is you don't save any taxes this year, right? You still pay with your after-tax income, but then you're done, right? So then they grow tax-free and you can take it out tax-free, right? So that's the difference between a regular and a Roth. A regular, there's no tax now, but you do have tax when you retire. A Roth, you pay tax now, but you don't pay tax when you retire. Both of them will grow tax-free. Right, so a lot of people, right, a 401k, right, that's managed by your company that you work for, right? So you have to have a company that's your sponsor in order to have that. So beyond that, you can have an individual account, an IRA, right? And they have their own limits, which are smaller, right? You can look those up. All right, the limit here is if you have a job with a retirement plan that you participate in, you can't do an IRA once your AGI gets high enough, right? You can, but it's not deductible, right? So you'll see if you're doing an individual account, instead of excluding your contribution from your income, you deduct it as a 4 AGI deduction. Basically has the same effect. Right, so, but right, you can still put money in, you don't get a deduction, right, if your income is too high, but that's still good because the money will grow tax-free, right, until you take it out. Right, so then you have a traditional IRA and a Roth IRA, right, is the Roth version is, you pay the tax now, but once it's in the Roth, it'll never be taxed again. You can take it out when you retire and there's no tax. So these have the same, once your AGI gets high, the rules say, right, depending on your status and stuff, as your AGI goes up, you can't make contributions to a Roth IRA. But what you can do, right, there's a loophole, Congress knows about it, they've just decided to leave it in. You can put money in a traditional IRA, and then later you can roll it over into a Roth. And so it's just as if you put it into a Roth. So higher AGI people can do that. There's all kinds of clever tax planning people do with Roth IRAs and stuff. All right, so you should understand the difference between a traditional plan and a Roth plan and why somebody might prefer one or the other, right? Like, right, if you, understand this slide, right, I would understand that, but it's pretty straightforward. And then you have these other options for self-employed people, which I think, right, if just a matter of reviewing those slides and understanding what those are about. So that's it for chapter 13. Anything stand out to somebody that you have a question about there?
No, I'm just curious, like if there's anything, but if there's not, then it's good. Thank you.
Yeah, no, I think it's just, there's nothing, there's not like something in chapter 13 that I'm like, this is really hard relative to other stuff. No, I think it's all stuff that, right, you gotta put in some time to review it and understand it, but it's something that you can do.
I have a question on I think it's called like a wash sale.
Oh yeah.
Because I'm confused on like, so if we sell it on the same day, it's like 30 days before and 30 days after. Yeah, I'm not too sure. Yeah, I'm just a little confused on that.
Oh yeah, so yeah, the day of the sale would count too. They're trying to be like, right, so what if like right now, so I don't follow the stock market close enough to know. All right, so what if I owned stock in, I don't know, some company that's really got hit? I own stock. Yeah, I own stock in Delta Airlines, right? And so it's just tanked because of the virus, right? But I still think, right, I still think long term, I want to hold on to it. I still think, I'm not saying I think that, right? This is hypothetical. I have no idea if you should buy airline stocks or not. Right, but I still want to hold it, but right, I would be tempted to, right, let's say my basis is $100. The current price is, I don't know what this is, right? Let's suppose it was 18. I would be tempted to sell it and deduct and get a loss this year, right? And then buy back the shares so I could hold on to them still, right? And so the wash sale rules say you can't do that. That's the main idea, right? So technically, so if I sell, let's just say I have one share. If I sell for $18 on May 10th, and I buy one share on May 30th for $18, right? All right, so technically, right, I have, and I'm going to sell my share. I'm going to have $18 amount realized. So that looks like a negative, right? Minus my $100 basis. I have an $82 realized loss, right? But because, right, so I have this period of, let's see, try to get fancy here. All right, so I have 30 days. Right, then I have the date of sale. Then I have another 30 days. Right, so anytime in this period, right, so I could have even, if I had bought my other share 30 days before the date of sale, on the date of sale, or 30 days after, it's a wash sale. So since I'm still in this period here in this example, all right, I have an $82 realized loss, but I have a $0 recognized loss, right? Because I didn't, they're saying substance over form, right? It's not like you really sold the share, right? You still have the exact same share. Yeah. So the only other aspect of that is my basis in the new share. So technically, right, my basis in the new share would be $18 because that's what I paid for it. All right, so that would be unfortunate if that was my basis, because then if I do sell it and not replace it, I would have no loss, and I would totally lose that loss. They're not that harsh. My basis in the new share is going to be the fair market value, right, the share price plus the disallowed loss, right? So it's going to be the $18 plus the 82, right? I'm going to have, in this case, right, if I'm replacing all of the shares, I'm going to keep the same basis. We had one example, so it's pretty easy. It gets harder if I sold all my shares and I only replaced some of them. We had an example like that. And you basically just want to split it into Right. So in our example, there was 100 shares and he sold 100 shares, but then he bought back 50.
Yeah.
I would treat it as I have 50 shares that I sold and replaced. So I'm completely disallowing my loss on that one and keeping my basis in the original 50 shares. And I have another 50 that I actually sold, and those I can recognize the loss on those. But yeah, it's sort of intuitive.
Okay. And then if it's like a gain, those gains are going to be recognized as an ordinary income, right?
Yeah. On this, like if I sold it instead of, I sold it at a gain here instead of at a loss. Yeah. I mean, it would depend on how long you've held the shares.
Okay.
But yeah, you have to recognize the gain, right? You don't get, the wash sale doesn't apply for gains.
Okay. And then for the test, I can take it anytime, right?
Yep, anytime. I think it starts at, I started it at 5 a.m., maybe even 4:30, right? Just in case somebody, and it goes until 11:59. But right, so you would want to start by 9 o'clock,
Right.
so that you, I think on the last midterm, I think it wasn't set. So you could technically go over the time. On this one, I think it's going to automatically submit once you hit 3 hours.
I'm going to pull an all-nighter tonight, take the exam at 5 a.m.
There you go. I would not recommend it. Not recommend it.
I mean, I'm sorry, but I mean, I can understand that, like 30 days before, I can understand it, but why they set a limit for 30 days after? It's kind of weird to me.
What you can, because it doesn't matter, right? So which one's more confusing, the before or the after?
Yeah, and I mean, why do they do that? Like I understand before because they don't want you to just, like recognize the loss right away like that. But why after? Like it's kind of weird to me. I just find it weird.
Yeah, I mean, I get it. The real arbitrary part is the 30 days part, right? Because so I could do this with Delta. I could sell it and I'll wait 31 days and buy it back, and then it's fine, right? So that's arbitrary. They're just making you take on some amount of risk, because maybe it'll bounce back and I'll miss a bunch of the bounce and I'll have to buy it at $32 or something, right? All right, but so it's just within the window, and it's before or after is the same thing, right? Right, because if I sold it here and then I buy it back a few days later, it's like I just still have the same thing. And so people might try to get clever and be like, well, I'm going to buy it before and then I'll sell it. So it looks like I just increased my position and then I decided to, right? But it's the same thing. If right here, I own one share of Delta, and right here I own one share of Delta, then it's like I didn't really sell it. Right? So that's what they're saying. It doesn't matter if it's before or after.
Okay.
I think the interesting thing is, I think the wash sale rules don't apply to bonds.
That's something we have to know for the exam?
No, that's just a tax nerd tip.
All right.
All right, because with or maybe it's even, there's funky stuff happening with bond prices right now, and so there's some interesting opportunities.
Mm-hmm. Yeah, I can't wait to get into the workforce. Bonds are always they've been something that interests me, because especially like municipal bonds and federal bonds, like even if you get a lower return, they're all risk free pretty much. So
yeah, it's interesting.
Yeah, I mean, into the workforce, I'm gonna buy some bonds in my city and state.
Yeah, I wish I would have had more bonds. The returns on treasury shares are right, like a lot of government bonds are right. If you held them in January, they're up like 30% this year or something. Plus they're safe as well.
Cool beans.
All right. Well, that's the time that I set. Well, if somebody else has a pressing question, I can answer it.
All tax project related.
Oh, okay. Well,
all of them.
I just have the question on that tax project, and that's it.
okay. Yeah. So yeah, tax project questions. I'll just try to do over email. Yeah, because if I answer, you know, everybody at once, and I guess it's probably not fair to people who figured it out on their own.
Okay.
Okay. Yeah. So I'll try to be really responsive to emails today. But yeah, I'll post a quiz video if I can. And yeah, get a good night's sleep. Good luck on the exam.
Cool beans. Well, thanks for the semester. It's been a fun time.
Yeah, it's been good. I was bummed that it got canceled.
Yeah, thank you, Professor.
Yeah, keep in touch, everybody.
I would definitely get that luck.
Yeah, the project's been a lot of fun. Just getting all the pieces to come together, and I mean your informations have been very informative. But oh my God, this tax project, I feel like it's teaching me so much about just this class in general. You know.
Yeah, that thing. Same for me. Yeah, there's no substitute to actually doing it. You learn a lot that way. Feels good too.
Yeah, I do my own taxes too, and every year I do a W-2 and a 1099. So whenever we got to that one part of the assignment where it gives you the W-2 information, I spent like a whole day looking for the W-2 form to put that information into.
Yeah.
Because whenever you actually do your taxes, you put in all that W-2 information, and it took me like a day to realize we didn't have a W-2. So good thing I started early.
Yeah, good thing.
Good thing I started early.
Yeah.
So yeah, that's been cool. But all right, cool beans. Well, thanks. I guess we'll be in touch.
All right, everybody. Yeah. Thanks a lot.
Yes, sir. Thank you.